Hello, and welcome to Synergetics Education's Legal English classes on individualized legal topics. We try to talk about specialized legal topics in these videos, and today we're talking about income taxes. Specifically in this video, we're going to be talking about the one part of taxes that we like, and that is income. The paying of taxes is slightly less fun, but when we're talking about income, whether it's for your business, for your corporation, or for you personally, income is what we really like talking about. So this one is more fun than the other ones where we have to start talking about paying taxes, but we'll walk you through some interesting legal English concepts as it relates to taxes. And that comes through various vocabulary terms, some various usage styles, and generally how we communicate when we're talking more in the world of accounting. But before we go on, my name is Jeff Keiser. I'm an American lawyer. I've been practicing for about 15 years now. I've worked on a lot of really big cases around the world. I've had clients throughout the United States. We've sued corporations in the United Kingdom and elsewhere in the world. I've worked on the BP oil spill case for about 5 years. That was my biggest one, but I also know a lot about the intricacies of the law and how it can work for you as a lawyer and as a human being. So taxes. Taxes are an interesting part of the law because it's not about case law nearly as much. Of course, there are case law issues that come up, but generally we're talking in the realm of accountants more than we are lawyers. So it's a very different system. It's a system nobody really likes to talk about. It's things that are unpleasant for everyone, and even the word tax is the kind of thing that makes people kind of cringe in horror. So I hope you'll come along with me on these 4 lessons, these 4 videos that all relate to taxes. In this video, we're going to focus on what income is. It sounds simple. I think that we all know generally what it is, but when we try to put it into words, it gets more difficult. We're also going to investigate some international income rules. Finally, we're going to talk about the importance of clarity, words versus numbers. But we're going to start with a little rundown of some important vocabulary terms as it relates to income taxes and other types of taxes as well. We'll start with an ad valorem tax. This is similar to a VAT tax or a sales tax if you're in the United States. Anytime the tax on goods or property is expressed as a percentage of the sales price or assessed value, that's an ad valorem tax. Aggregation. When we have income, it sometimes comes from multiple sources, and we aggregate those sources to get our total income. So aggregation is used to discuss adding together income from all sources to determine your total tax liability. Assessment. This is the act of computing what you owe as a tax. It is assessing your income and your deductions and your credits for a year and using accounting principles to come up with how much tax you are owed. The worst word in tax is an audit. And this is when an outside entity, whether it's some kind of an auditor from an accounting firm or the government, they will come in, analyze your books, and tell you whether or not you've been honest. Nobody wants an audit, ever. Capital assets are taxed differently than income, and they are, succinctly said, Property held as an investment. If you own a home, it is a capital asset. Deferred income. Technically, it's not really your income until it is received by you. So sometimes we defer that income to make it appear as if we haven't earned it at all. Of course, when it does come into us, it will become actual income and we will have to pay tax on it. But until that point, not at all. Direct taxes. These are what we pay annually. These are income taxes, capital gains taxes, and sometimes in some countries, taxes on a person's net worth. Things like gift taxes, death taxes, and property taxes are also direct taxes. Your effective tax rate. Most countries use what is called a marginal tax system. And we'll talk about that in its own slide. But it's a mode of being a progressive tax on income, but determining its effective rate, your actual rate paid, is slightly more complicated. This definition is good, but we'll talk about that a little bit more later. And excise tax is any tax imposed on an act, an occupation, a privilege, a manufacture, sale, or consumption. A flat tax. This has been an idea that's been thrown around in the United States for decades to make a lower rate of income tax that applies to everyone. It's not progressive in many ways. It's also not a regressive tax. We can talk about this later, but to me, it's not essentially fair to tax billionaires at the same rate that we tax a school teacher. But maybe that's my own political bias coming in. One more slide of these and then we'll get into the fun stuff. Indirect taxes. These are based on transactions, goods, or events. These are things like VAT or a sales tax. VAT is a value-added tax that exists in many countries and Europe especially. Other things like stamp duties, excise taxes, services, registration, transactions, those are all what they call indirect taxes. Passive income is not income that we earn from an employer. It is income that we receive for doing nothing. If you own an investment property and receive rental income, that is passive. Dividends, interest, these are other examples of passive income. Safe harbor is an interesting concept in the law, and it's when the tax authority, the IRS in the United States, for example, they give guidelines on how the law should be interpreted. The safe harbor process will say that some transactions may be authorized without any further questions. It's an easy way out. Nobody wants to dig into all sorts of accounting for smaller things. So they create what they call safe harbor. And finally, a withholding tax. This is a tax that is taken out of your paycheck on a monthly basis, or in each paycheck, let's say. Your boss, your employer, is tasked with calculating how much to take out every month so that you don't find yourself owing a great deal at the end of the year. It's a nice thing to happen, actually. And when people talk about getting a large tax refund, that's what we're talking about here. It's taxes they've already paid into the system through withholdings, but they'll get back through deductions and credits and other things that may not be expected when that withholding was calculated. All right, so that's some good vocabulary, and we're going to move on. Income. It's exactly what you think it is. It's money that a person or entity like a corporation receives in exchange for their labor or investment. It's the money that your boss pays you. It's the money that My boss pays me. That's the easy way to do it. Of course, there are other sources. Passive income, like we mentioned on the last slide, is one source of that. But income is the money that comes to us. This is typically broken up into two different forms. First, ordinary income. Ordinary income is, how should we say? It is the money that your boss pays you for working your job. It's usually distinguished from capital investment income, which we'll cover on the next slide. Ordinary income is different than that distinction between direct income or indirect income or passive income. Ordinary income includes all of that. Earnings, interest, dividends, rental income, distributions from pensions or retirement account, everything. In the United States, this income is taxed at rates ranging from 10% to 37% as of this year. Again, those are marginal tax rates, and we'll discuss that on another slide. Capital gains, on the other hand, are income that is realized from selling assets that have appreciated in value. So if you've bought your home 20 years ago for $100,000 and you sell it today for $500,000, that would create $400,000 of capital gain income. In the United States, you'll note that these are taxed at a rate ranging from 0% to 20%. It's much more complicated than that, but you'll notice that those rates are much lower than the taxes from ordinary income. Qualified dividends are also taxed at capital gains rates. And dividends are money given to you if you hold shares of stock. Not all companies give them, but some do. I want to take just a moment to talk about the scope of income in the United States. Now, I know none of you are criminals or doing anything that would be considered illegal, but even if you were, illegally gained money is still income as considered by the United States IRS. If you embezzle money and you don't report it as income, they can come after you. If you steal money, if you have a bank heist, still, you have to report that on your income taxes. In Gilbert versus Commissioner, they came out clearly and said that no matter what the source of your money is coming into you, it is income and has to be reported on your income taxes and pay taxes on it. You might remember the famous gangster Al Capone. They didn't put him in jail for any of his crimes. They put him in jail for not reporting the money that he received for his crimes. It's an interesting story, and I recommend that you read all about it. So, let's just say hypothetically that XYZ Corporation has profits of $50 million in 2022. For corporations in that income bracket, the tax rate is 21%. So, if there were no deductions or credits or other loopholes, that corporation would be liable to pay $10.5 million in taxes alone. The good news is there are lots of loopholes and lots of deductions that can help us greatly. Okay, so that's a little bit about income. We're going to revisit this hypothetical in the next video as well, when we're talking about credits and deductions. We'll try to get that price down a little bit. That's the job of a good tax lawyer, right? It's getting that 10.5 million down a bit. But before we get there, I want to talk about 3 different forms of income taxation. And this will apply whether we're talking about corporations, individuals, other entities, anything. Each country has its own form of income taxation. They're generally based on these three systems: citizenship-based taxation, residence-based taxation, and territorial taxation. We'll talk about these pretty quickly, but they're very different concepts, and they're important to know, especially if you want to work in the area of tax law. As to citizen-based taxation, there is only one major country that operates in this system. Unfortunately, it's my country, the United States of America. The only other country on earth that does this is Eritrea, and even though I'm well-traveled, I do not think I could find that country on a map. So, what does this mean? This means that I, as an American, have to declare my taxes to the IRS no matter where I live. I currently live in Argentina. But even though I make all of my money in Argentina and I am never in the United States, I still have to report that income to the American tax authorities. There are some tricks around this and some good ones. For me, if I spend less than 30 days in the United States each year, they have what they call the foreign earned income exclusion. This means that I don't have to pay taxes up till I earn $108,000, which so far hasn't been too big of a problem. But it's still based on my citizenship. It's not based on where I am or anything else. Most countries, more than 130 of them, use a residence-based taxation system. These are most of the industrialized nations on Earth, including the European Union, Canada, Australia, New Zealand, Japan, Korea, and more. You'll note that there are roughly 220 countries on Earth, and so this is a substantial majority of them. So, as soon as an individual becomes a tax resident in that country, they automatically become liable to pay taxes there. So what does this mean? This means that because I live in Argentina, I have to pay taxes on my worldwide income in Argentina. Now, there are tricks around this, and one of them is to simply give up your residency in that country. There's what they call the 183-day rule, where that means that if you're not there for half of the year, you're not a resident. This becomes tricky when you're never anywhere for 183 days in a year, but that's still how they test whether you need to pay taxes or not. It's much more complex than that, and each country definitely has its own rules and regulations. Finally, there are about 40 countries, so what is that, about 20% of the world, little less, that operate on a territorial-based taxation system. We're talking Panama, Paraguay, Thailand. You'll note that these are countries that have been considered tax havens. Here, only income that is actually generated inside that country is liable to tax. So, if I was living in Panama and I was doing legal work in another country, let's say Austria, I wouldn't be taxed by the country I was in. There are weaker foreign-controlled company rules, making the tax rules a little easier to work around. These are countries that are fantastic for second residencies. Once you're there, you can live there all year long, earning your money abroad, and you don't have to pay taxes on them at all. Unfortunately, as a citizen of the United States, I would still be liable to pay taxes there. I know. I'm a loser on that front. There is one last system of taxation, and they are what I like to call the unicorn countries. And there are 23 of these countries that don't charge any direct taxes at all. Now, I know that sounds like a magical place that everybody would want to go live, but believe me, they are not. These are countries that have a lower quality of life, or they make it next to impossible for a person like myself to reside there. To show you a global map, there are a handful of islands in the Caribbean and a handful of countries in the Middle East. Frankly, I don't want to live in any of those places. The Caribbean islands maybe a little bit more, but they make it really difficult to stay there. I've tried. So I wouldn't try to say, well, I'll move to Saudi Arabia to become tax-free. It's not that simple. So before we move on, we're getting towards the end of this video. I want to stress that when we're writing, when we as lawyers are writing or working in the tax world, it's easy for us to hide behind a stack of numbers or Excel spreadsheets, because that's how we determine what taxes due. But when we do need to write, we want this to be as easy to understand as possible. We want it to be clearly understandable for anyone to understand. And really, that's because accounting is complex. And to put that into words is often very difficult to understand. So, think clearly. Clarity of writing usually follows clarity of thought. What do I mean by that? That means outline what you're trying to say before you say it. Organize your writing. Next, think about trying to express your statements in as simple a way as you can. We lawyers do love to use big words and complex sentences, especially when we're working in tax. Try to keep it simple. Shorter paragraphs, shorter sentences, shorter words. They are all your friends in this context. Next, think about writing it for your specific audience. Who's going to be reading this? Is it going to be an accountant? If it is, maybe you don't need to write anything at all and you can just hand them the Excel spreadsheet. If it's for a court, maybe you need to focus on the legal concepts. If it's for a client, you may need to dumb it down a little bit, make it a little easier to understand. And finally, in the tax world, keep your writing as short as you can. We don't need to argue a lot of alternative arguments. We need to say what's happening and what we're doing in response. All right, guys, that's the end of this video. I know this was a long one. I think the other ones are going to be a little bit shorter. But next time, we're going to talk about deductions and credits. These are the things that we need to understand to make our clients happy. And how we do that? We make our clients happy by giving them their money and letting them keep it. All right. Thanks so much for spending this time with me, and I look forward to our next session. I'll be back with another video very soon. In the meantime, have a fantastic day.